Selling a used company car. It often comes with a major headache, right? And that headache is usually GST. It's a super common situation, but if you get it wrong, you could end up paying thousands more in tax than you actually need to. So in the next few minutes, we're going to cut right through all that confusion and give you a simple, clear answer.
Okay, so your company is ready to sell one of its cars. You found a buyer, you've agreed on a price, but now you're stuck wondering, how exactly does GST work on this? Do I charge the full rate? Is there some kind of special rule I'm missing? Look, these are exactly the right questions to be asking, and you'll be happy to know the answer is surprisingly straightforward. Believe it or not, this whole complicated tax thing, the rate you use, the amount you calculate on, all of it, it all boils down to the answer to just one single question about that car's history. You get that one thing right, and everything else just falls right into place.
All right, let's get right to it. This is the crucial fork in the road for your entire GST calculation. And here it is, the big question. Was input tax credit, ITC, claimed when the car was originally purchased? That's it. That's the whole puzzle. Your answer, a simple yes or no, determines exactly which set of GST rules you have to follow. So what exactly is this ITC we're talking about? Well, the simplest way to think about it is like a refund for the GST you've already paid on your business purchases, in this case, the car itself. You get to use this credit to lower the amount of GST you owe on your sales. It's a really fundamental part of how the whole GST system works. Okay, so based on the answer to our big question, we have two completely different paths to take. Path number one is for when you did claim ITC. And path number two is for when you did not claim ITC. We're going to walk through both, and we'll start with the one that's actually less common. So let's talk about path one. What happens when ITC was claimed? Now, this is the rarer situation, and you'll see why in just a second, but it's really important to understand how these rules work. The logic here is pretty simple. If you got a tax credit when you bought the car, you've got to pay the full tax when you sell it. That means GST gets charged on the entire sale price, the whole amount, at the standard high rate of 28%, plus any cess that applies. And most importantly, you cannot use the special margin scheme we're about to talk about. And that brings us to path two. Now, this is the scenario that applies to most businesses, where ITC was not claimed when the car was first bought. This path is governed by a much more favorable set of rules called the margin scheme.
So you might be wondering, why is this the usual case? Well, it's because the law itself, specifically Section 17(5) of the CGSD Act, pretty much blocks companies from claiming ITC on motor vehicles. Now, there are a few exceptions, like for transport companies or driving schools, but for your standard company car, ITC is usually not allowed. And that's why most businesses end up on this path.
So, what is this wonderful margin scheme? Honestly, it's a huge relief for businesses. Instead of paying GST on the entire selling price of the car, you only pay GST on the profit you make from the sale. That's the margin. It's just the difference between your selling price and the car's depreciated value. Put simply, you're only taxed on your gain. And the good news doesn't stop there. Not only is the amount you pay taxed on lower, but the tax rates themselves are lower too. Under this margin scheme, you use these concessional rates, just 12% for smaller cars or 18% for larger ones. I mean, compare that to the 28% plus cess from the other path. The savings can be absolutely enormous. Now, here's the absolute game changer. What if you sell the car for less than what it's worth in your accounting books? What if you actually make a loss? Well, in that case, your margin is negative, and the GST you have to pay is zero. Zilch. Nothing. No profit, no GST. It's that simple. Okay, theory is great, but let's put these rules into practice. We'll run through a real-world example so you can see exactly how the margin scheme can save you some serious money. Okay, so here's our setup. A company bought a large car a few years back for 10 lakh rupees. Crucially, they did not claim ITC. Today, its written down value, or WDV, in their books is 3 lakh rupees. They found a buyer, and they're selling it for 4 lakh rupees. So the formula we use couldn't be simpler. Our taxable amount, which is the margin, is just the sale price minus the written down value, or WDV.
So let's plug in our numbers. That's a 4 lakh rupee sale price minus the 3 lakh rupee WDV. And that gives us our margin, our profit, of exactly 1 lakh rupees. This is the only amount we need to think about for GST.
And since this is a large car, we apply that 18% concessional rate. So 18% of our 1 lakh rupee margin is 18,000 rupees. And that's it. That is the total GST the company needs to pay, not on the full 4 lakh sale price, just on that 1 lakh profit. So just to recap that example, selling the car for 4 lakhs meant paying 18,000 rupees in GST. But what if the best offer they got was only 2.5 lakhs? That's less than their 3 lakh book value. In that case, the margin is negative, and the GST payable is a big fat zero. So a profit means a little bit of tax. A loss means no tax at all.
All right, we've covered a lot of ground, so let's boil everything down into a simple, easy-to-use cheat sheet that you can use for any future car sale. Here's the entire thing in a nutshell. If ITC was claimed, you pay the high rate 28% plus cess on the full sale value. Simple, but expensive. But if ITC was not claimed, which is the most common case, you pay the much lower rate, 12 or 18%, and you only pay it on your profit margin. That's the core logic right there. This means your first step, every single time, is always the same. Go back, dig out that original purchase invoice, and check it. That one document holds the key and tells you exactly which path you have to follow. And that brings us to a final thought to leave you with. Now that you have this clarity, is it maybe time to take a look at your company's policy for getting rid of assets? Making sure your whole team understands these two very different paths can save you from some really costly mistakes down the line. It's definitely something to think about. Thanks so much for joining this explainer.